Hi guys, Adrian, Chase, Peter. Thank you so much for joining me today. This is my second attempt to do a great panel. The first one went really good on Tuesdays, every Tuesday at I think 8 p.m. CET morning in America. I think noon, depending on where you are. This is a little bit earlier, so I'm curious how it goes. Before we start in the topic, I want to talk about Strive, what they just announced today. I want to talk about the treasury, the strategy earnings call that happened, I think, last week, and then also all the other things that we can get to. But before we get into that, as it's the first episode, it's the first live stream, I just want to get everyone introduced and see who we got here today. Let's just get it started with Chase. How are you doing, Chase? And tell us a little bit about who you are and why you're here.
Yeah, hey Robin, thanks for putting this together. I'll keep it really quick. Been in Bitcoin since 2015. Multiple time founder, co-founder of different businesses. Some exits, some still operating, one of which that's still operating is Acropolis. And my new company where I'm COO is Savannah, where we're helping tap real estate equity to buy Bitcoin.
Peter?
Nice. Hi, everyone. My name is Peter Duan. I've been working in traditional finance for the majority of my career, which is 14 years. Spanned quite a different range within traditional finance. Started off at Cantor Fitzgerald doing structured finance and commercial mortgage-backed securitization. Had experience with financial products, worked in investor relations at an S&P 500 company, and most recently was on the wealth advisory side.
Interesting. And Adrian?
Hi, everyone. Adrian Morris. I'm sure that some people watching know me. I am a member of True North. In my day job, I do a lot of work with AI, consulting, data, analytics, business analytics, some algorithmic design. I also advise a couple of treasury companies, and I've been in Bitcoin forever now. So I bring a lot of pain and suffering and experience to my conversations.
I love that. Really cool. Let's directly get started. The thing with the one that made me change the title and the thumbnail of today's episode. I was thinking about talking more about the strategy side of things, but Strive just announced the daily Bitcoin dividend. Just I think like 3 hours ago or 2 hours ago, something like that. How do you guys look at that move? As Adrian said before the recording, the obligation stays the same, just the payout period. What I think a lot of people are confused about is strategy, which is in the same jurisdiction, said there's a 10-day limit to the payout, and I think it's a notice period, and that's why they're not moving to daily, and that's why they do it twice a month and want to move to semi-monthly. And now Strive announced the daily. How is that working? What are you kind of seeing as insights here?
Well, Matt Cole actually just posted about that one, not maybe just, and it's about the NASDAQ 10-day rule. So there's still 10 days between dividend declaration record. That is the limitation that strategy is referring to. But there's no requirement of 10 days between the record date and payment. So they've just essentially found a workaround of the frequency, but not the overall obligation or the timing of the record and the notice. So I think that's how they found a workaround for that. And it's a smart move. I think that everyone's been talking about, well, daily dividends. Structurally, you still can't really do it if you are using preferred equity. However, now what they've done is they've just found that workaround that allows them to have the same obligations, the same overall mechanics behind it. They're just paying it out daily instead of weekly or monthly.
Yeah, so just to add on to Adrian's point, it's the exact same amount of dollars going out their door. They're just doing it now on a daily business day basis, which is around 200 or 250 days out of the year. What that does is quite a nice number of things. But the most important, which in my opinion, is that it actually increases the effective yield because it compounds on a daily basis, as opposed to a monthly or bi-monthly basis. And again, if you were to look at Punter Jeff's presentation, it actually shows you the math on that.
Interesting. Is this actually because I think strategy and Strive is interesting because they're in the same jurisdiction. I think with Peter, I talked recently about MetaPlanet, how they have a unique standpoint. They are not competing directly with strategy because they are in Japan and strategy is not in Japan. But with strategy and Strive, it's interesting. There's like direct competition basically, and the main difference is they pay out higher, but the strategy has the higher Bitcoin stack. How do you guys look at that long term?
Well, I don't think they're in competition. So they are in competition, but not in direct competition. I think that they are just two of the pioneers, while strategy obviously the leader, right? But with Strive being I think they're gunning for that number 2 spot. And I think what they're trying to do is they're trying to differentiate themselves in the market. And one of the things I talked about I think back in March now is that I can see strategy perhaps reappropriating other prefers for other payout cycles. With Strive doing this, I can see strategy taking a similar stance on one of the other prefers, but that's something that they're going to consider longer term, because while it would be nice for strategy to have a daily dividend, I don't necessarily think they need to do it. They would only do it if it gives them a appropriate or perhaps disproportionate advantage in the market. Stretch right now is seeing the kind of volume that I think they are relatively comfortable standing pat with that. They're not going to make Stretch daily now, right? But could they reappropriate one of the other preferreds and restructure it to serve that purpose at some point, perhaps?
Yeah, it's a different story, right? Everybody knows strategy is the 800-pound gorilla. Nobody's going to overcome their gigantic Bitcoin stack, but at the same time, that comes with its own hurdles as well, right? Right now, they have still convertible debt hanging over them on top of 4 other preferreds. So it is a bit of a messier story. Again, if you were to look at Punter Jeff's tweet presentation today regarding the daily dividend company, they have a very clean story. They've been around for a little bit over a year. They only have 1 preferred on the balance sheet. They have no debt. The amplification ratio is at 40%, and so it's a very clean story. But at the end of the day, I don't really see them in direct competition. They're just helping each other grow and evolve.
I think the 4 ways that I've seen the differentiation between SATA and STRC is obviously SATA is offering the slightly higher yield and now offering the daily dividend. So there's like 2 points where they're trying to differentiate on what is typically on the long run pretty much the same overall strategy. The other, which Peter just mentioned, is that Strive is debt-free as of now, and therefore has kind of the cleaner, simpler balance sheet story. Even though obviously MSTR strategy has the bigger, stronger balance sheet, but also Strive is willing to do some M&A in there as well, as proven with the Semler deal. So that seems to be like the 4 areas where they've found differentiation to date, is the slightly higher yield, the higher frequency of dividend, the debt-free, cleaner balance sheet, and some accretive M&A.
Is there anything negative on the daily dividends? Like, I'm asking because when I saw the semi-monthly dividend announcement of strategy, I was actually asking, like, why are they not moving to daily? People are like, didn't you see the announcement? Because there they said about the 10-day limit, and I'm like, okay, Strive showed that there's a legal way to do daily. Now I'm thinking again, like, why didn't Stretch? Is there like a downside to move from semi-monthly to daily?
Maybe just operationally a little bit more difficult to work with like the operators to issue the dividends, but I don't see that to be a long-term problem. And also, this actually speaks to another one of Strive's advantages, is that they actually have some of the best. So in my opinion, Matt Cole is probably the best recruiting Bitcoin Treasury CEO. He obviously got Punter Jeff, Ben Workman, but also one person that's not mentioned is their chief legal officer, who is a Yale law professor as well. And so it's obviously with that kind of expertise that you can find workarounds like the one that we just talked about today, which is moving to this daily dividend structure.
Probably doesn't hurt with Vivek winning the governor race in Ohio too. That's probably some pretty good political power behind the company now as well.
Yeah.
Vivek is involved in the company.
Yeah.
He's a bigger
founder, if not co-founder, founder.
Yeah.
I was not aware of that. Interesting. So as people might see in the following episodes also, I'm probably the newest to Bitcoin Treasury company in this round, definitely, and I'm on my learning journey since December. I'm now quite deep on the strategy. The other ones I haven't researched in any deep levels whatsoever, only surface level, but I'm really curious on learning on them. Let's move on.
So one of the potential, not a negative, but just a consideration, is that now they've gone from what, 1 or 2 recording periods per month to 20, in theory, because they have to, if they're paying it out on a, and I haven't watched the full presentation yet, they're paying it out on a daily basis, they would still have to record what they're paying out and how the funds are appropriated, and so on and so on and so forth. So it does create operational complexity. But on the flip side, because they're smaller, that is easier to manage. For strategy to do this, it'll be more difficult because of their size, their footprint, and all the moving parts that they have. So that's just one thing that I'm not going to call out as a negative. I'm just going to call it out as an operational consideration.
Yeah. You could also look at that as an opportunity because, for example, now Strive has something daily that they could announce to the market. So kind of if you want to think about how Punter Jeff and Ben Workman and Matt Cole and things like the hurdle rate use this to kind of create a daily content stream that could actually end up being useful.
Yeah, that's one of the things I called out in one of my group chats. I said this is about sentiment and perception as much as anything else, right? Not so much about the mathematics behind it. I think that with Saylor calling out the realities of market sentiment on the earnings call, and now people are starting to realize that with a novel asset class, you're going to need to get buzz and going to have to keep buzz going. You're going to have to kind of give the plebs what they want. And people have been asking about daily dividends. So now that they have that, that is something, just as you pointed out, that they can come to the market every single day. It's like Saylor's tweets get retweeted all the time, and the weekly announcements about Bitcoin get tweeted out all the time. Similar with Strive, they can have a daily cadence where they're always calling out dividends are paid out today, X amount of dollars, so on and so forth.
Yeah, it also helps with DeFi being built on top of that as well. And also just like, as Adrian and you guys already mentioned, it's a great marketing tool, right? And I love that they called out realty income as the example. So realty income, for those who don't know, I used to come from the commercial real estate side. They are a REIT, a real estate investment trust, and they're known for paying out monthly dividends and always increasing their dividends. I think they're part of the dividend aristocrat, kind of categorization, which is a pretty high threshold. I think you have to pay out like either 10 years or 25 years in perpetuity for your dividend obligation. So yeah, it was a good analogy to say, hey, realty income was an innovator in that space. Now we're doing the very first daily dividend structure, and I think that's going to help with the marketing as well.
I'm curious on that note of the DeFi, what you guys think this changes in relation to the digital money, as Saylor refers to it, being built on STRC versus now those types of projects may be looking at something like SATA because of the daily or daily business day frequency. Do we think that actually changes which underlying digital credit those types of upstarts might look to?
Well, yeah, I think so. Stretch is very attractive for the obvious reasons, and also because it very, very quickly got up to scale and got the volume that it needed. Right now, SATA is still, it's scaling, but it's still proportionally smaller than Stretch. So the rails that are built on top of it I think are going to take more time to scale out, but they're coming. And when I say more time, I'm not talking like a year or two. I think within a couple of weeks, people are really going to start looking into thinking about how they can have other rails on top of SATA, whether it be DeFi, whether it be tokenization, the list goes on. And the one, and again, this is not me being the bear, this is just me being objective. The more rails that exist on top of these, the more risk that there is. Because if there's one thing we know about the crypto space is that someone is going to try fuckery, and that can break things. So we need to be aware of, we love the growth. We think the rails are going to be built, and the rails are going to be built, and they should be built. But we should also be very, very mindful of the ones that we think are a good versus a ill.
That's a good point. But another thing that we haven't touched upon yet, which is again in Punter Jeff's presentation, is the fact that they observed the behaviors of Stretch, obviously the study Stretch and their own preferred instrument SATA, to see how it reacts like ex-dividend date and how long it will take to recover back to par. And so when you're resetting it on a daily basis, they anticipate that the volatility will be dampened significantly, and therefore they'll be able to hit par more often. And if they hit more par often, they can ATM those more. And so that creates a flywheel effect.
Yeah, so that's one of the things I actually watched as well with Stretch. People were, trying to rotate in and out of Stretch and timing it, but the thing is, they're still getting caught by slippage. Yes. So what is the thought process is that if you eliminate the impetus for rotating in and out, you eliminate that slippage, you eliminate that ex-dividend drop down, right? And you can stay closer to par and be above par more often, and as Peter said, ATM more effectively. I personally thought that the notion, and not to offend anyone, the notion of rotating in and out of the preferreds just didn't make any sense. Once I started modeling it out, there's no way to account for the slippage because, again, these are growing instruments. So what I think Strategy and Strive are trying to do is they're trying to eliminate the incentive. They're trying to stabilize the volatility, however little volatility there is. And the more stable it is, the more likely they are to grow. And grow consistently.
Yeah, and they love to use the Sharpe ratio, right? And so for those who don't know, it's just the risk-adjusted return adjusted by volatility. And so if they're able to reduce the volatility, which is on the denominator side, then that jacks up the Sharpe ratio quite a bit, and that is yet another vector for good marketing.
Yeah, and they already have the higher yield. So if they can bring the volatility down, you could actually see them beating STRC in terms of Sharpe ratio. The way I'm looking at this very high level, like zooming way out, is kind of how I look at Bitcoin versus things like Ethereum and Solana. So Bitcoin has the size, the scale, the liquidity, and these other crypto projects are kind of the test net. And if something really wins in terms of use case, Bitcoin can adopt it in the future. And when it does, it will just win that use case because of the natural volume and liquidity and size that is already sitting in the Bitcoin network. I kind of see that now happening with Strategy and Strive, where for a long time, Strategy was the innovator in all of these different areas. But now you have Strive and others that are trying to differentiate in the world of digital credit, pushing the limits. But ultimately, if Strategy looks at what Strive has done here, there's nothing that they can't replicate, and therefore just kind of maybe take market share because of the existing volume that they have in their products.
What I will say is that if Strategy ever does a daily dividend, I think that things become a little bit prickly in terms of what is going to attract attention. At that point, what is the differentiator? Which is why I'm inclined to say I think Strategy can, consider a daily dividend at some point, but unless they're trying to eat some of Strive's lunch, I don't know what the impetus is. If they think there's going to be extreme interest in it, I can see them doing it. But again, you already had, Stretch going with monthly, and then Sato was monthly. Okay, great. So now Sato's is going daily. Okay, great. So now is Stretch going to go daily? I don't think so. So is Strike going to be reappropriated to go daily? Are they going to come out with a sixth offering to fill that gap? I don't know. So I think that Strive and taking that initial, I don't want to say risk, but I think risk is the appropriate term, to go daily and see how the market will react. They may have carved out a niche for themselves by doing that. Because at this point, again, in terms of perception, you have to think of it in terms of, well, strategy goes daily. Now people are just going to say, well, why didn't you do it first? And why are you just following Strive? So there's all kinds of ways that this can play out.
Unless they do it by the minute, which would be hilarious. I'm just joking. They'll never do that. But
well,
no, I agree with you.
That would just be dumb. But yeah.
I agree with you. I just, strategy likes to be the innovator, and they're not going to be the copycat. So I agree with you. They're just going to leave Strive to probably be the daily dividend company, and they'll find definitely many other ways to tap into the capital markets. I'm not worried about strategy doing that at all.
I mean, Saylor always talks about leaving it to the third layer. Like he has Stretch, he has laser focus on that, and leaving the every minute payout, the every hour payout, the everyday payout to the third layer of what he calls, I think, digital money with the stable coins and the DeFi projects.
Yeah, I think that's another point, that when you're reducing the volatility, you're effectively taking that opportunity from DeFi. Like you're absolutely right. So Saylor's saying Bitcoin's layer 1, then you have preferred as like, or Bitcoin as like layer 0, the preferred is layered 1. And then there's probably a layer 3 that will reduce the volatility even lower or pay out in a higher frequency. Now I think the Strive daily thing will just take some market share from those DeFi opportunities.
Yeah, I think I disagree. I think I can see strategy taking from the playbook if they track volumes on SETA and they see that, oh, it looks like the market wants this. Oh, we figured out how they got around the 10-day loophole. Because if you look at what they did, years back, they were talking about, okay, we'll let, Metaplanet have the Japanese market. We'll let so-and-so in Europe have that market. But then eventually they got hungry for that extra market cap and they launched STRE. And in the recent earnings where they talk about going bi-monthly with STRC, the whole rationale for it was, as you called out, Peter, wanting to increase the Sharpe ratio by increasing the frequency, as Saylor often talks about these things. The frequency of the dividend lowers the volatility, increases the Sharpe ratio. And if this proves that it does that for SETA, I don't see why strategy would not embrace that, because he said on the earnings call, now that we have digital credit through STRC, our focus should just be on making it as good as possible.
That's right.
Well, that's fair, and the one caveat I'll bring up with that is that Stream has had very little interest.
Yeah.
So they launched it. They thought there'll be desire for us, but they're finding out that not so much. So, to your point, if they see the volumes justify it, could they go to a daily model? Yes, but the differentiating factor at that point would only be what? Size? I think people don't care as long as they get the dividend. So they would either need to go with a higher daily interest, or they would need to find some way that makes it different from SETA. And not impossible. I just think that with all of the parts that they've got going on right now, I just don't know if it benefits them, really, because they're just adding more complexity into their model right now.
Robin, you're based out in Europe, right? Why do you think there is a lack of demand for Stream out in Europe?
I'm not even sure if it's already available for retail. Like that's one thing. Like all my European friends that buy preferred from Stretch, preferred from Strategy, they go to Stretch. They can buy Stretch in all the brokerage accounts. It's not expensive. We just had a huge crypto exchange in Europe, and they just added Stretch to the portfolio, and you can buy it in Europe directly from the platform. they don't offer Stream. I don't think Stream is actually available for retail. I could be wrong, but Stretch, we have good access to the American market in Europe, so there's not that much need to have we don't have some of the benefits. So the tax deferred thing is not here in Europe, obviously, so we have to pay capital gain the dividend tax. I don't know what it's called in English, but when I buy Stretch and I do a little bit, I get an effective rate after taxes of like 8 or 9% and not the 11.5 because I have to account for the taxes directly. But I think that's the main reason why people don't really why the volume is not as big. If it would be a retail push and it would be in all the platforms and distribution, I think Sale and also Fong talk a lot about distribution. So you have to go to all the European, even crypto and Bitcoin exchanges, and they would need to implement Stream for actually having that huge retail volume. I mean, that's my best guess.
Yeah.
Well, so then hypothetically, is Stream a target for the reappropriation that I talked about? Can they take that and reappropriate it to, say, a daily income stream? I think that sells itself. So in terms of a potential target for repackaging, reappropriating one of the existing preferreds, I have no idea how that would occur. Or the intricacies of it in terms of the, launching in a European market, having an American analog, or having a bicameral structure like a Series A, Series B, something like that. When it comes to Stream, I think that can be a target for a daily because I think it just works. But again, there would have to be the impetus for it. If SATA daily is huge, a Series B Stream or reappropriation of Stream is not out of the question. But I just think that there will need to be a real impetus for them to consider that, to add the operational complexity at this point.
I think out of all the other preferred, Stream will actually make the most sense because there is no preferred product out in Europe. And so it won't be directly competing with SATA. And there's already, filings there. And so if, as you said, Adrian, there is impetus to be able to legally convert it to daily, I think that would reinvigorate and drive new volume to Stream.
I have one more question on that topic. Michael actually put it up there. He said this will reduce the cost of capital through demand for daily. Is that a thing that SATA might see, that because of the daily move, demand will be higher for their preferred, and so they could actually lower the interest that they pay out closer to what maybe Strategy is paying out, because now I think they're paying 13% and Stretch is paying out 11.5%. So they have a higher cost of capital. I'm not sure if Michael meant that, but that's kind of what I got from that.
I mean, I guess your ability to remain as close to par as possible keeps you from having to increase the dividend, but I don't see it really allowing them to decrease the yield.
Yeah, so the interest in the daily aspect is because of the yield, right? So if we assume that the yield is going down, we have to assume the price of Stretch, SATA, has been going up. And they've been ATMing and they've been lowering the interest rate as a result. Okay, fine. That is, in theory, a way that can theoretically impact the cost of capital, but I don't really think it's going to be that clean, because the volume would have to be consistently above par. And guys, check my logic here, because I'm half awake and I'm thinking this through. The volume would have to increase proportionally and consistently enough for them to be able to ATM it and raise enough capital to lower the interest rate in proportion, right? So if it just stays at par, nothing changes.
Right. It just doesn't get more expensive. Yeah. And I think this gets to the broader point of, do SATA and STRC actually want to lower dividends, or do they just want to capture more ATMing and more underlying Bitcoin? And I believe, and Saylor said this on multiple podcasts just over the last couple of weeks, that they're in the growth phase. They're thinking of this as Amazon offering free shipping, where they're willing to have a higher operational cost in order to gain more of market share. And so I personally don't see these yields coming down anytime soon, even if overall interest rates do start dropping with the new Fed chair.
Well, let's think it through. What's going to cause the effective the yield for Stretch and Seda to go down? Like, because what I just mentioned is if the volume goes up, if the price goes up, that's going to cause them to lower the dividend a little bit, and because they can ATM it more, right? So to answer your question, I don't think that they are aiming for lowering the dividend, because I think it's a two-part question. There's what the market is going to force them to do in terms of overall consideration. Then there's what the volume is going to allow them to do. I think that they are fine with having to lower the effective dividend on Stretch because they've been ATMing it and they've been able to ATM it, right? I think they are also okay with increasing it to keep demand there, so it allows. So here's what's really interesting about these offerings. They want to increase the interest rate to attract additional volume and buyers so that they can decrease the interest rate. I think that's what they're doing. They want to increase it to attract the attention that allows them to decrease it because it's been sitting above par. So it's a very delicate balance that they're kind of striking right now with Stretch. So I think, Chase, to your point, I think it's yes and no. They do want to have reasons to lower the dividend, but it's what the reasons will be to lower the dividend, if that makes sense.
You don't think that they'd rather just hit the ATM harder to drive it back to par and just capture more underlying Bitcoin at a phase where we're still so early and the monetization is still such cheap Bitcoin prices with the soft market right now?
Yeah, well, but the thing is, they keep saying above par, they're going to have to lower the dividend, right? So
I guess what I'm saying is every time they're above par, they just smash the ATM issuance to push it back down to par. That's allowing them to capture the capital that goes and buys the Bitcoin. I feel like they'd rather capture that extra Bitcoin collateral to the company's balance sheet than try to actually push below par to lower the yield by 25 basis points the next month, which is the maximum they can do anyway on a month to month. Because, what do they care about 25 basis points in the long scheme of them believing in a 30% compound annual growth rate for Bitcoin?
Well, what I'm saying is if they are above par, to your point, yes, they want to keep it there. They want to keep the interest there. They want to be able to ATM consistently, right? But if there is a reason to lower it, I'm just trying to think through what reasons there would be. Because the only reason why I think volume went up is because of market conditions. I don't know if it was necessarily because of the actual dividend that they were offering. So I just wonder what the balance is going to be.
So I can see a scenario where, say, for instance, we go through a pretty steep bear market and people say, okay, the common equity is, because it's amplified, it's too risky. And so we're going to move that capital into the preferreds. But then they're not going to be able to ATM the preferreds if it hits above par at this current high cost of capital, because they need to maintain an amplification ratio. And so when in a bear market, then their net asset value gets crushed. So the amplification ratio goes really high. And so they're going to probably want to lower the dividend obligation during a bear market, because then there will be then they'll create less demand, right? Let me think if I see this through. There'll be less demand, and therefore, any excess that actually eventually hits par, they're able to ATM to actually maintain a healthy amplification ratio. Does that make logical sense during a bear market?
But does that assume that there's less demand for STRC in a bear market? Because I almost feel like it's the opposite, where there's more demand for digital credit in a bear market.
That's exactly what I'm saying, is that there's going to be more demand in a bear market. Okay. Therefore, they're going to artificially lower that demand by reducing the dividend, right? And so then you can still maintain a healthy amplification ratio, because you need to maintain a rough 2-to-1 ATM on the commons to Stretch.
Well, so when it comes to the common stock ATM, and I think this is where they're going to consistently get themselves into trouble, the MNAV is not really what is going to justify that. They've been below 1 and the volume's been insane. So they can have high volume at a high price and high volume at a low price. And if they're seeing that they have sufficient volume to be able to raise capital in the common, they can be leaving billions and billions on the table by just saying that, well, they need to maintain some kind of an arbitrary ratio between stretch and between, the common stock. And I'm not saying that's wrong to do. I'm just saying that I think that volume, so market perception, volume, demand is going to drive what they do more so than the amplification ratio that they're trying to maintain, and more so than a potential dividend interest that they're trying to maintain. That's what I'm trying to get across.
So then do you see like an amplification ratio like going to like, I don't know, 200% during a bear market? I think that would be a very high risky thing for common shareholders now.
It would, but I'm also the wrong person to ask about that because I don't really care about the amplification ratio. My investment in strategy when I first got into it, and as I've maintained it, has never been about KPIs that they release. It's been about $1 in MSTR gives me 1.2, $1 in Bitcoin gives me 1.1 or 1. Or the options market allows me to do different things and find application in different ways that are tied to the volatility of the equity more so than the price performance of the equity. So I'm really the wrong person to ask about the amplification ratio or Bitcoin per share or anything like that, because I think they're largely irrelevant. But I'm just trying to think through what are the scenarios that they would have to navigate in a bear market, in a bull market, because Chase brings up a very, very good point, which is why it got me thinking about, well, what would justify what would justify them either adjusting their strategy, pivoting, so on and so forth.
Yeah, I mean, that's the thing, right? It's like if eventually strategy is going to be more and more institutionally owned. And so when you're more institutionally owned, they're going to care about the KPIs, right? And that's one of the many difficulties of strategy, is that you're effectively creating a new industry with your own KPIs, and yet the story constantly is evolving and it's very hard to keep up. Like, for example, I think Robin, we wanted to talk briefly on Strategy's earnings call, right? Well, this is the first earnings call in which if you watch headline news, it would be like, Saylor says we'll sell Bitcoin, but it's like, okay, well, why do you say that, right? And so it's this always evolving narrative that's very hard to get behind if you're an institution, because the cycle for institutional approval to buy a stock in large chunks is much longer than in retail investors. And so, yeah, that's why it's like they move so fast and they change the narrative so fast that it's hard for institutions to catch up, in my opinion.
I think
it's going to matter what KPIs.
Agreed.
I do not think, and I may piss people off, but I don't really care. I don't think anyone's ever going to care about Bitcoin per share at the institutional level in any way that's going to make them change their decision-making process around these equities. I think that the ultimate arbiter of who's going to invest in what is how much money is this going to make me. Bitcoin per share is a KPI about efficiency of capital allocation. Fine. That is not a KPI about efficiency of return. So I think that I think strategy is, they're balancing who they're communicating with. They're communicating with the retail investment group, but they're also trying to gain favor and gain an additional footprint in the institutional world as well. And I think that the institutional world has an entirely different set of KPIs versus the retail investors. And that the only KPI right now that I think that everyone is like uniformly interested in is how much is Stretch going to grow, how much is SATA going to grow, how quickly are these things going to get to scale, are they going to be able to pay the dividend? If we're talking about the preferreds, I think those are the KPIs. When it comes to the equities themselves, it's going to be price performance. Not going to be Bitcoin per share, application ratio, or anything like that.
I mean, if Stretch is extremely successful, then automatically the Bitcoin per share will be good, and automatically, not automatically, but like very likely, strategy will also be. Is that what you're kind of saying, that you're more likely to watch if you? It's better to watch what Stretch is doing from volume perspective and how successful it is. And then kind of the second order effect is that the Bitcoin per share is going up because they can raise capital, they can raise Bitcoin. And then the MNAV maybe might be more interesting because they have a very successful preferred equity also.
So those are two separate questions. So the first part of the question with regards to Stretch, and this kind of ties into what Chase was saying. Let's say that Stretch is very, very successful and they're able to, well, not let's say it is. It has been very, very successful. And let's say that we're still in a bear market and this continues and Stretch is successful and they're able to ATM and buy Bitcoin, right? Bitcoin per share is going up, but share price is doing this. That doesn't really matter. You have more Bitcoin per share, but you don't have any claim on the Bitcoin. So again, it is a KPI about capital efficiency and how efficient they are at acquiring Bitcoin and the cost of that Bitcoin and how it can be represented on a per share basis. But that is not a direct correlation to anything having to do with value. It is an efficiency metric in the case of Bitcoin per share. And also something that people don't really pay attention to is that it's actually a metric of decay. Bitcoin per share has nowhere to go but down over time because Bitcoin is a finite asset. And shares are always going to go up. So Bitcoin could be successful, which it is, and be extraordinarily successful. But if Bitcoin is ripping to 250, 500, and 100 and $1 million a share, a coin, Bitcoin per share is going to trend down, right? So is it trending down? Is that a bad thing? Or do you see what I'm saying? Bitcoin per share is a metric about efficiency. So that's the first part of the question. The second part of the question, this is something I'm going to keep hammering until people like really get it. MNAV is about market sentiment. It has nothing to do with anything that strategy does. There's no lever that they can pull that's going to make that MNAV go higher. That's going to be directly correlated to market conditions, sentiment around Bitcoin, sentiment around strategy. And if you like what I've done with MNAV over the last, since like August 2020 to now, is that I've modeled it out. Strategy has been in very, very persistent and observable compression and expansion regimes when it comes to MNAV. And those tend to decouple from Bitcoin and move more tightly with Bitcoin depending on market conditions. So again, is MNAV by itself, just like Saylor said in the earnings call, market sentiment, market belief, perception around the equity, around the preferreds, that's going to drive belief, that's going to drive the reflexivity, and that's going to drive MNAV higher.
Adrian, would it be fair to say that when looking at Bitcoin per share growth compared to traditional ways that we value equities, that you think about it as basically IRR or something like profit margin, where it doesn't necessarily speak to the market cap or the growth of the per share price? It's really just about efficiency of operations?
It is about efficiency because, and this is not me saying it's an invalid metric. This is me saying what it is a metric of, in my view. So Bitcoin per share, one of the reasons why I don't really necessarily consider it at all is because I don't have any claim to Bitcoin. Even in the case of a liquidation event, it is not as if they're going to give me a proportionate amount of Bitcoin per share. I'm going to be paid out in cash. So from a standpoint of value, I am tracking something I have no claim to. So that's the first reason why I consider it a measure of efficiency and not value. The second point is, if we are trying to compare to traditional metrics, we have to be very, very careful about what we do. The BPS EPS comparison, that's something that has been said. The problem with that is EPS is driven by operational revenue. It's driven by operational income. It's driven by operational growth. In the case of a Bitcoin treasury company, the growth is tied to the underlying asset. So that is net asset value accretion mentioned and measured on a per share basis, but that is not earnings per se. It can be reported in a similar fashion. It could be seen as that way. It can be mental benchmark for that. But if we are being very like logical and honest about it, BPS, EPS, or BPS doesn't really track to traditional metrics. That's why I say that we have to view it as a KPI. How efficiently they're using the capital, whether it be from the preferreds, whether it be from the common, to accrete Bitcoin that's going to grow the net asset value of the company, not the per share metric of that asset. Does that make sense?
And the issue with Bitcoin per share is also the fact that it does not include the claims to it, right? It does not include the preferred claims or the debt claims to it. That's why I really like the CEB tracker, because it does net out the debt obligation and the preferred obligation. I also agree with you that because Bitcoin per share or Bitcoin yield will naturally asymptotically trend towards nothing because of the hard cap nature of Bitcoin, I think eventually MSTR will need to change that narrative, because still, if we were to listen to the latest earnings, their true north metric is Bitcoin per share. But eventually, I think they'll need to change that narrative to say the biggest stack is that much more capitally efficient to acquire the next available Bitcoin on the market. And so I have yet to see them signal that. But to me, that makes the most amount of sense.
I think that so, and this is why I'm being very, very fair with what I'm saying. And this is why I always try to differentiate between who they're communicating with. Bitcoin per share is for the retail community. That is not for institutions. That is just my view. I think that strategy is constantly having to navigate between the different groups that they're communicating with, and they have to find messaging that resonates with each group. And to your point, Peter, I think that inevitably Bitcoin per share and Bitcoin yield is going to be something that they trend away from. But also, as a Bitcoiner, and again, this may piss people off, but again, I don't care, using Bitcoin denominated valuations doesn't make any sense. That assumes a world where everything is on a Bitcoin standard. And by definition, if you are in a Bitcoin treasury company, or you're trying to value Bitcoin treasuries, or you're using Bitcoin as the denominator, you are begging your own question. You are changing the measure to a measure that supports your thesis. But what is Bitcoin priced in? Dollars, yen, pounds, euros. Bitcoin is and always will be priced in fiat currency, whether we want to accept it or not. So I think that while it is beneficial to have Bitcoin-centered, Bitcoin-focused, Bitcoin-denominated KPIs, the reality of it is that even if we were going to go to a hyper-Bitcoinized world at some point in the future, we need to have a realistic appraisal of where we are now. And the valuation metrics and the KPIs that we use should be trended towards the now with an eye towards the future.
Yeah, it's like
sorry, real quick. I just had a question to Adrian, because you were saying that if the Bitcoin related KPIs don't matter and you're an institutional investors, you care about the volume growth on Stretch, for instance. But yet you also say that these preferred Stretch and other preferreds have no claim to the Bitcoin, then why would an institutional investor care about the volume of Stretch? Since the Stretch volume could be high, but the common shares could actually trend downwards as well. So what, as an institutional investor, would you want to invest in MSTR in that case?
Well, the reason is because, and this is one of the reasons why I've been hammering the point about MNAV and so on and so forth. The entire market for strategy right now is driven almost solely by options. The interest in strategy is heavily in the options market. A lot of the volume that we're seeing is being driven by the dynamics in the options market. Going back to, I think it's August of 2024, the last time I did the analysis, a fully 25% of the price action in strategy is attributable to the options market. So that is what institutional investors are interested in. Strategy is, people classified it as a beta Bitcoin play, right? Which is accurate. the movements bear that out. The game that's being played is in the derivatives market. At several points, the open interest in strategy has been larger than the market cap of the company. Strategy has had share volume on par with Tesla in the options market globally, on par with NVIDIA, on par with a lot of Mag 7 companies. And their market cap hasn't really moved in proportion to that. So what that tells me is, when I look at the data, when I look at the market, and when I look at what I'm doing myself, the reality of strategy as an equity is a leveraged beta options play to Bitcoin. People are betting on Bitcoin with leverage through strategy. That is what institutional investors are interested in. Go ahead.
Sorry, do you foresee that to continue to happen, or do you feel like as Bitcoin gets bigger, they're going to that percentage volume on options divided by the market cap is going to dwindle, and therefore there'll be less.
It's only going to get bigger.
It's only going to get bigger
exponentially. So as Bitcoin's price grows, the interest in strategy will grow exponentially, and the options activity is going to grow exponentially. So to give you so open interest overall has been bigger than the market cap of the company itself. Gamma exposure, so that's how market makers hedge. That's been a fraction of market cap. So what that means is a fraction of the market cap of the company was being used to hedge against the company. That's a very, very unusual dynamic for an equity that hasn't crossed a market cap of 120 billion yet. That you see that at times with NVIDIA or Tesla, because this is something that I watch when I'm doing my analysis. When I say that the options market is driving everything, Mag 7 and strategy, and now that semiconductors and so on and so forth, when you're seeing the explosive growth in these equities, the explosive growth is being driven by volume and investor interest, yes, but the real push, the real volatility is being played out in the options market. Realized volatility is at the price level, implied volatility is at the expectations about price, and that's what's pushing things. That's what's creating the wild oscillations in amplitude. So strategy is going to be, in my view, the vehicle for Bitcoin exposure at the institutional level, more so than Bitcoin in a lot of ways. I thought, go ahead.
I was just asking, do you also think that Bitcoin volatility then will go up?
I think that Bitcoin's volatility, ironically, will go down. It will not be, I think we're a long ways away before Bitcoin becomes, I don't want to say stable, but where we're not going to see it go to 126 and then down to 70, right? However, this is my view. I think what Saylor has done, and he's been telegraphing this the entire time, volatility is vitality. He's making strategy the vehicle for Bitcoin exposure for the world. That's what he's doing. I think the end game is that he's going to financialize Bitcoin to such an extent that no matter what happens, strategy is going to succeed, because he's a believer in the Bitcoin thesis, as we all are. So let's just think it through logically. Bitcoin's at what, 79, 80K, whatever it is right now. Let's go into a future where Bitcoin is at 250K. Strategy owns 1 million Bitcoin. Their market cap is ridiculous, right? Do you think, Peter, coming to your point, it is more likely that people are going to say, I'm not going to bet on it now, it's too big? Or because it's much larger, I'm going to place much larger bets?
Yeah, I'll place larger bets. But my curiosity is that you used NVIDIA and Tesla as examples of large open interest ratio to the market cap. But if you look at, say, for instance, like both of those, they actually have, Tesla's actually has been rather muted, in a relatively narrow range, while NVIDIA has been up and to the right, but because MSTR has amplified Bitcoin, I can see that actually, where like it's going to be really violent and really on both directions for quite some time. So that's as we're talking this out, it actually makes a lot of sense that you see institutions' involvement in MSTR as a volatility vehicle much less than kind of a long only type of strategy. Is it? Did I get that
Yes.
correct?
Yeah,
Okay.
institutions are using strategy as a volatility play. Another data point. What do you think the ratio is between the heaviest ATM issuance and the heaviest daily short volume?
No idea.
30. There's been 30 times the daily short volume than there has been ATM issuance at the heaviest point. That's the actual ratio between the two. So the heaviest short interest at any point since August 2020 to now has been 30 times the heaviest ATM issuance. Why do you think that is? That is convertible bonds over a longer period of time, hedging. That is also because there's heavy betting in the market saying we think this is going to fail, and we're going to bet that it's going to fail. That's what short interest essentially is. On the daily level, the short interest that we're seeing on the longer term level from the convertible bonds is I differentiated between stock and flow. The longer term short interest from the converts is stock. That's consistent. The daily short volume that we're seeing is flow. That's what you're really seeing in the market in terms of sentiment, in terms of what they think about the equity. So at two levels, I am seeing consistent options market activity that even when it dies down, it's still in the top 10 or top 20 globally.
Yeah.
And I'm seeing short interest that's oscillating and going on a very, very, I don't want to, it's not systematic, but it's a very apparent regime. And the analysis that I do on strategy, I do an analysis from everything from the equity to Bitcoin to the options market. And Chase, you're going to go in a hot second here. I just want to get these three last points out. One, even when MNAV has collapsed, the volatility ratio between MSTR and spot Bitcoin has relatively been 2. So it's still been twice as volatile. So when everyone hears about 2x Bitcoin, they focus on, well, that should be 2x MNAV or 2x performance. But like you just pointed out, to the downside, it could be 2x as well. And that's where the 2x volatility tends to maintain itself. The options market, with the volume of a company being a fraction of the size of NVIDIA and Tesla, still having top 10, top 20 options volume, that says to me that it is a volatility play. Tesla, NVIDIA, they're volatility plays. I mean, I just ran it the other day. NVIDIA's average trading volume is something like 30 billion a day, and you can see anything between 3 and 6 billion of that being short interest. So that's obscene, right? So that's the second point. The third point is, going back to what you were asking, Peter, as Bitcoin grows, as strategy will grow. As Bitcoin and strategy grows, and as Bitcoin's footprint becomes more steady state, they're going to have to go to a different vehicle to get that volatility. Institutions were using Bitcoin directly through the futures and through all their shenanigans up until, I want to say, 2024. I can almost see it like it's a dead mark on a calendar. Mid-2024, that shifted. And the options, you started seeing everyone on Twitter talking about options on strategy. Everyone was talking about covered calls. Everyone was talking about how I'm using strategy to get premium, to farm premium, so on and so on and so forth. I think strategy is going to be the levered vehicle for Bitcoin going forward and into the future, more so than IBIT, more so than Bitcoin itself, more so than the futures market. I think that is what's going to be one of the end goals that's coming.
That's very interesting. This is, oh, sorry, go for it, Jason.
Yeah, let me just jump in on that. So 30% short interest, Adrian. So what should we expect there when strategy eventually retires the converts? Because now you have less of that hedging, but does that maybe also negate some of the short narrative because now they can claim that they are debt free as well as the Bitcoin being unencumbered, and maybe it actually wipes out some of the short interest that remains post-convert hedging?
Well, the short interest was never because of it. The Bitcoin's always been unencumbered, right? So
Right.
The short interest isn't about, and let me be specific here. Short interest is stock. That's the constant short pressure that we're seeing from the convertible bonds. Daily short volume, what I'm talking about, the 30x, is flow. That's what we're seeing on a daily basis. That's the daily amount of shares that are being sold short, okay? So in terms of, let's talk about what the difference is between the two of them. That consistent short pressure when the converts are eventually bought back, that will dissipate. However, that is not tied to necessarily a narrative. That is tied to, we gave you $1 billion, we gave you $3 billion, we're going to hedge our bet.
Right.
So structurally, that's a different consideration. The daily short volume, I think, is where most of the shenanigans happen. The gamma exposure is where a lot of the shenanigans happen, and I think that the ratios can stay relatively the same. I don't see them going up to like 50% or anything like that. What I do see, however, is, to your point, and this is where things are going to get interesting, as the converts come off of Strategy's balance sheet, that creates less opportunity to create pressure to the downside.
Right.
So then shorts are going to have to proportionally increase their daily shorting to push the stock down. You do that in a market where Bitcoin is trending up, you can get offsides very, very quickly because of that volatility. Because Strategy is twice as volatile as Bitcoin, even in a depressed market. So that makes things interesting.
So retiring the converts actually increases the probability of a short squeeze in an up market?
It doesn't increase the probability, it decreases the likelihood of it being stopped. Those are two different things.
Okay.
Increasing the probability of a short squeeze would be me saying that the short pressure is gone, short squeeze is going to happen. What I'm saying is, without that stock, that constant pressure acting as a cap on potential price, the likelihood of a short squeeze happening is more likely, because if you get offsides in the wrong trend, you very, very quickly are forced to buy back the very shares that you're trying to use to pressure the stock down, and you get caught in a position where your own short is driving the price higher. The gamma squeeze scenario, right?
Yeah.
So that is why I'm being very specific to say that removing the converts in and of itself, in my view, is not enough to create a short squeeze. Having the converts gone creates an environment where a short squeeze can happen.
Right.
But the short squeeze situation, I find it really interesting, because I see Strategy as one of the most misunderstood trades of all time, because the TradFi community doesn't like it because of Bitcoin, and the Bitcoin community doesn't like it because it's in the TradFi it's in the TradFi world, and so like there's a lot of Bitcoin maxis that hate on Strategy, and there's a lot of people in TradFi, obviously, that like hate on Strategy. It's a really interesting kind of stock sitting in between two tensions.
Well, you know what's interesting about his position in the market right now, and so the analysis that I did on Strategy price action, I actually accounted for Bitcoin miners in it as well, and the rotation that happened between Strategy and Bitcoin miners and how that was affecting the price. So Bitcoin miners, and I used 9 of them to test this, they accounted for 16% of price variance. So very, very simply, what that means is, over the course of 4, 3, 2, 1, 6 months, so 4 years to 6 months, as I trended it, the Bitcoin miners could attribute roughly 16% of price variance. The reason why I'm bringing that up, to your point, Robin, is this. When the Bitcoin miners have been pivoting towards HPC and AI, and they're becoming more akin to HPC AI plays, once that buying pressure from the Bitcoin miners shifts industries and goes from a dual play to more playing in the market of where NVIDIA and Palantir and so on and so forth, where they play more wholeheartedly and getting more interest in that way and having more price performance in that way, the hatred for Strategy, I think, is going to have to go through a very, very interesting place, because it then becomes the primary Bitcoin proxy again that it was in 2022. So Bitcoiners are going to have to say, do we hate the fact that this Bitcoin equity is now trading at a high multiple and it's TradFi, so on and so forth? Or do we like the fact that they have 1 million Bitcoin on their balance sheet? They've brought stability towards the Bitcoin narrative. Strategy is now the leverage play. We have Stretch, we have SATA, we have all these other offerings that exist on top of Bitcoin, all of those additional rails that exist on top of Bitcoin because of Strategy. How are they still going to hate on it at that point? That's something I'm curious about, how that's going to play out.
It's even like, for me, like if like it's hard for me to say because up until December I was kind of hate on strategy, and then I looked into it and I'm like, it's kind of hard to hate on it if you really know what they're doing, but it's just such an interesting trade. And I think Peter brought it up before. The Saylor is very famous for saying sell your shares, sell your kidney, but don't sell your Bitcoin, like something along those lines. And now he's saying, yeah, we have the option of selling Bitcoin, but I'm actually kind of surprised how resilient the market to that news was. Like there's no real drop or like anything. Like there's a lot of like Twitter uproar. There was a lot of memes coming out of that, but there was not like, I feel like the market already understood that Saylor might sell some Bitcoin, and then selling is a weird word because like he's still a net accumulator of Bitcoin.
Well, they've sold Bitcoin before in December of 2022.
Really?
So yeah, they have.
I didn't know that.
That's why the narrative just doesn't make sense. They sold Bitcoin in 2022. I think it was like 116, something like that. And then they bought back more Bitcoin than they sold. But they did it because it was tax advantaged. So they realized the tax benefit for it. Now, this comes back to what I was saying about messaging. Strategies communicating to different groups. When Saylor is saying sell your kidney, don't sell your Bitcoin, he's talking to Bitcoiners. When they're talking about selling Bitcoin in a way that's tax advantaged, they're speaking to the market and institutional investors. And I think people need to really differentiate between Saylor, the Bitcoiner, and the meme lord versus Saylor, the chairman, and Phong Lee, the CEO. And that's something that I can do, and I don't think it requires any kind of intellectual duplicity on my end, because I know that as a operating company, they cannot be the dyed-in-the-wool ADHD Bitcoiner that I want them to be. They have to adapt to the market. They cannot say, we don't care what's going to happen in the market. We don't care what's going on in the world. We will never sell Bitcoin. Right. They can't do that. So when Saylor, in my view, talks about never sell your Bitcoin, has he sold any of his Bitcoin? I don't think so. I haven't seen any news about that. He still owns like 17,000 something. So he hasn't sold his Bitcoin. Even when he was saying that, before that point, Strategy had sold Bitcoin. So this is why I think that people are talking about this that aren't really informed and paying attention to it. He's been saying never sell your Bitcoin after they had already sold Bitcoin. So his message has not been diluted or altered. I think we just need to be aware of who he's talking to.
I think another thing here is people forget that this strategy with STRC would have always worked even if they didn't issue MSTR ATM to pay down the dividends. You know, you can raise through STRC and still sell Bitcoin that you buy through your previous capital raise of STRC to pay down the dividends. And as long as Bitcoin's CAGR is above that dividend yield that they're paying out, it does work in perpetuity. And it is not a Ponzi, as many would refer to it when they're looking at the ATM issuance of the common to pay down the dividends. So that, I think, I don't think it's by accident that Saylor used the word inoculate. I think his earnings did two things to inoculate the market. One is remind people, hey, this is not a situation where we have to tap the MSTR common to pay down dividends. This strategy works even if we just isolate STRC in its own little bubble here. And then the second being, obviously, whether it's conversations with existing credit investors or maybe the rating agencies, as a bit of foreshadowing, it's very clear that they have to be clear that in a scenario where they need to make good on the dividend payment, that they have to be willing to touch the Bitcoin. Otherwise, the Bitcoin balance sheet, that collateral base that is supposedly backing, even though unencumbered, backing the dividend payments, if people think that he'll never sell the Bitcoin and that he'd rather go down and never, not make good on dividend payments to die with the Bitcoin, well, then it doesn't really create the value that Bitcoin collateral base is meant to do to establish the credit issuance. So I really like this idea of inoculating the market on both of those fronts.
There is this, sorry, I just to jump in because I didn't understand one word that Chase was saying. What does unencumbered mean? Like maybe I'm lacking English skills here.
Basically, it just means that they don't the STRC. Well, let's nobody has a direct call upon the Bitcoin. There's nothing that will liquidate or margin call the Bitcoin. The Bitcoin is not being directly posted as collateral. They're issuing credit based on the balance sheet strength of the Bitcoin, not actually encumbering the Bitcoin as collateral that can be margin called or liquidated.
There's no claim against it. So
No
basically,
claim.
no one has any claim on the Bitcoin, but strategy. Or
Makes sense.
investors in the liquidation event. But even then, it'll be sold and they'll be paid in cash. So no one has a direct claim on the Bitcoin.
So that's why whenever you see like someone say, "Oh, like margin call," like everyone who's been following this is just like laughing their butts off, because it's like, dude, that's like 101 if you like want to understand MSTR, is that none of the Bitcoin is encumbered. Like this is why Saylor also says Bitcoin can fall to like 90%, stay there for 5 years, and as long as Bitcoin, returns 2.2%, like we can pay our dividends into perpetuity. So a lot of people don't understand that. Like it sounds almost too good to be true, but again, it requires like a lot of digging and following this company to figure out what it means. And I think taking a step back, it's like this company moves so aggressively, and the narrative has to change because it is such a new industry that it causes a lot of confusion. But as a result of that confusion, you're going to get a lot of either love or hatred for the stock, which actually at the end of the day only benefits MSTR because it increases the volatility. So at the end of the day, like Saylor is just going to do what he does. He's going to go 100% in this direction, innovating, and he can change his narrative. But at the end of the day, for those who follow it, we understand what's going on. And if you don't follow it, you can short it or you can express your view by lying it. And at the end of the day, it only contributes to the benefit of MSTR through its volatility.
I gotta ask you guys, what did you think when you heard him mention that he could even issue STRC to raise capital to buy back MSTR shares when we're at what he believes is too low of a premium? I mean, what was your kind of reaction to that?
Well, so that kind of harkens back to something we talked about in True North about defending MNAV. That's when they first initially mentioned it, and I got a lot of hate for saying that they can't defend MNAV for the variety of reasons that are called out. Mm-hmm. What I think is the most potentially beneficial path is not necessarily buying back MSTR shares. I have reasons why I don't think that will matter too much. Paying off convertible debt with the converts, I think, is a better. Sorry, paying back convertible debt with the preferreds, I think, is a better course of action. If they were, and again, I think this is just something they should consider. If Stretch is having the volume that we think that's been having and maintains that volume, if MSTR keeps maintaining trading volume, I don't think they are harmed by taking a little bit off the top and building out a cash position and just eventually going to the market and paying off a convertible bond using that. I think that would be far more beneficial than buying back shares, because reducing the amount of shares in circulation when you're still using a model that's issuing shares to the market doesn't really make sense. Reducing shares in a way that is structurally beneficial to the price action of your company makes sense.
Yeah. How much?
And I think that they are two slightly different things.
Do you remember how much roughly in convertible bonds is outstanding right now? What that number is? Is it like
it's on the strategy website? It's like I want to say 7 billion, 8 billion,
7 billion-ish. Okay.
I can't recall.
Yeah, I'm looking at it right now. It's 8.2.
8 billion. So 7, 8 billion, like I said. Yeah. So if and I want to be very specific about why I'm saying that I don't think the share buyback is the best course of action. So you use share issuance through the preferreds and through the common to raise capital that you then use to buy back shares that you then go to the market again and issue shares.
Yeah.
The immediate net benefit of that, I think, gets washed out over time. If you, however, use issuance and capital raises to reduce the debt on your balance sheet, and the debt is proportionally also tied to the amount of short pressure that's on your balance sheet, you're getting 2 bites out of the apple versus 1. That is why I think that, just buying back shares doesn't make any sense. They issue $1 billion to buy back $1 billion, then they issue $1 billion again. It doesn't do anything.
You could argue there's a third bite of the apple too, which is similar to what Strive announced today, where they're pushing this, we are debt free. This model is debt free, right? So that's, a narrative improvement as well.
Well,
I think
this was already mentioned in the earnings call, is that Fong, I believe, alluded to the fact that they're actively going to raise capital, find ways to buy back the converts and become debt free.
Yeah. Any buyback should be the converts, not buying back direct shares. I don't think that makes any sense.
Totally agree. I guess I'm more thinking after they've retired the converts, which they've already signaled they want to. Now they've also signaled that they could in the future issue STRC, raise capital, and buy MSTR to defend the MNAV, which I understand it's not really an ability to defend MNAV, but so much as capture back Bitcoin per share, which I know we have our issues with, when the premium is not favorable. And so it does seem like that could be something post converts. I'm talking world where we've already retired the converts. It does seem like a new lever that many, including me, hadn't really thought of.
Well, the one thing that the caveat with that I'll still raise is, yes, you have a point, but let's think about what that means, both from a terms of the mechanics and in terms of what it says to the market. If you're buying back shares that you're just going to issue again, that's a wash.
But you're going to issue them again at a premium, right? You're not going to issue them again until you feel like you're getting the value for your operations, for your overall treasury business.
You are issuing them again at a premium, and you're in theory getting more money for that issuance, but you're still assuming that the market, it's not just about the premium, it's about the fact that if we want to talk about the Ponzi narrative here or the reflexivity of this, some people call it a Ponzi, I call it reflexivity, right? I think we all will call it reflexivity instead. Yeah. If you are issuing shares at a premium and you're getting more capital for the shares that you issue, that's fantastic. And are you saying that you're going to buy back the shares when they are lower and then issue them and assume you can issue them again at a premium? I think that there's no world where they can buy back shares in volume with the common stock being depressed with the preferreds. That would imply that the preferreds are significantly above par. So let's use Stretch as an example. Stretch will have to be significantly above par. They're issuing those shares. They're using that issuance to buy back shares when we're depressed, and then they will issue shares again at a premium. If we take a look at the dynamics right now, Stretch, even though they've been able to issue billions in terms of overall issuance, when I take a look at the short volume that exists on the stock, and when I take a look at the dynamics in the options market, that wouldn't have moved things a tick. We would have to assume that they're buying back shares now, then they wait until they're at like a 2x MNAV or something like that to get return on that investment.
Yeah, because the MSTR volume is just so much bigger than the STRC volume right now that there's just no way to actually move the market meaningfully there. Yeah.
And so in that scenario, bear market scenario, like that scenario that you laid out is effectively the same bear market scenario, where you're only going to buy back MSTR if it's below 1 MNAV or 1.22 MNAV or whatever, right? But then again, in that scenario, like the amplification ratio is really spiked. If they're trying to keep a healthy like 2-to-1 ratio, that's not going to work mathematically.
Yeah, I'm not caught up on my amplification ratio math, to be honest.
Just think about it like, okay, like just pretend that like from where Bitcoin is at right now, 80,000, it chops perfectly upwards to 120, ATMing, Stretch and MSTR at the same 2-to-1 ratio, okay? And then in a bear case scenario where it drops from 120 to 60K Bitcoin, MNAV, the net asset value gets cut in half, amplification ratio effectively doubles. And then if you were to use the ATM on stretch to buy back MSTR, yet you still need to maintain a healthy amplification ratio, that math wouldn't work.
Which is why I think Bitcoin per share and application ratios should be the KPIs. They're great, but I think that they are unintentionally handcuffing themselves by coming up with different KPIs that the market will accept.
I agree.
They have to be market adaptive, is what my view is. And amplification ratios are great, but again, I'll piss people off, don't care. I've talked to a lot of individuals that I know that own strategy shares in size. They don't care about Bitcoin per share, and they don't talk to me about amplification ratios. They talk to me about the different dynamics when it comes to the short interest. They talk to me about the options market, so on and so on and so forth. So I think that these ratios and KPIs are very, very useful in terms of sending a message, but I don't know if they're going to be very useful in terms of long-term driving the strategy that they initiate on a daily basis.
Let me ask you, Adrian, are those people that you're talking to, are they more like traders where they're trading the amplification, or they're long-term holders?
They're long-term investors, and so let me be more specific. If you're talking about options traders, yes. If you're talking about people that rotate in and out, no. So a lot of the people that I know that trade MSTR options, they fall into two camps. They're long-term holders that trade options, and that they're also traders that trade options. Most of the people that I know, I can only speak to the cohort that I know. They are long-term holders that trade options.
Yeah, makes sense.
And they have thousands and thousands and thousands and thousands of shares.
Yeah.
So they're the ones that I'm referring to when I'm talking about the options market dynamics. And also the few individuals that I speak to that are more on the institutional side. I'm not going to say any names. Again, there's people that there's about messaging. You're talking about one thing publicly, but privately, your investment strategy is different, right? So publicly, you understand the importance of a narrative. Privately, you understand the importance of managing your own book.
Yeah.
And that's what they're doing. And what I just hear consistently is, it's not about application ratios. It's not about Bitcoin per share. It's about what can I do in the options market? What is the share price doing? How much money can I put into stretch, and how much money can I get back on a dividend? How can I arbitrage that? Can I use the stretch dividend to buy MSTR shares that I then play in the options market? There's all sorts of different things that come up where these other KPIs are just not that much of a consideration.
So slight different subject, but with this new announcement of SEDA going daily, does that change how you're thinking about personally investing in stretch versus SEDA?
Me?
Yeah.
I mean, I own SEDA and I own stretch. I don't think it's gonna. It doesn't change anything for me, again, because I'm a person that never really bought into the whole arbitrage between the two. I bought them, I held them, I got the dividend. That's all I was really concerned with. I didn't really do drip or anything like that on it, because in my view, the whole point of getting the dividend is to have income that you use.
Yeah.
So what I've been using my income from, and I think I did a post about this, is I've been using it for my API tokens on all my AI usage. So it's turned that into zero cost. And my token usage
nice use case.
Yeah, and my token usage is ridiculous. So that's why I was like, how do I prevent myself from constantly dipping into my rolling income? And I just said, well, let me just put X amount of dollars in stretch and say that, get the dividends. And I've been literally taking the dividend and putting it into my token usage. And it's been working out great, because that's a multiplier, right? The tokens are making me very, 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 very productive in terms of the automations, in terms of the algos and whatnot that I'm refining and reworking. And essentially, I've turned that into a zero cost event that I can then scale. So
beautiful.
That's awesome. You're living in the future, Adrian. That's awesome. I assume you're a long-term accumulator of MSTR. Do you plan buys around MNAV? Like when you think MNAV is 1.1 to 1.2, that's like a lump sum moment? Or how do you think about long-term accumulation of MSTR?
So I have my hodl position that I haven't touched. and I have positions that I've rotated in and out of. So you guys have probably seen me say, if MSTR drops to X, I'm backing up the truck, right? Whenever I say that's a quick swing trade. I buy it in when it's low and I get out again when it's high. So that's what I've been doing. I've also done similar to NVIDIA and Tesla, but NVIDIA is also the other equity that I have a hold position, but I've also been rotating it out of. In terms of MNAV, so this is where I'm going to again buck the trend. But when I talk about MNAV on X, I'm not speaking about someone that has a theoretical opinion on it. So I've actually been modeling MNAV out. I've modeled MNAV out from the EV MNAV side when they made the switch in early 25. But I've also been modeling MNAV out from the longer term side since they've adopted a Bitcoin treasury strategy. In my view, if you really want a true understanding of MNAV, you have to use what I call pure MNAV, which is Bitcoin price times Bitcoin holdings over market cap. That is the true gauge of market sentiment.
Can you
Enterprise value.
say that again? Can you say
What
that
was
again?
that?
Can you say what that is again?
Oh, you just take Bitcoin holdings times the Bitcoin price, and you have them under the market cap. That's how you get it.
Okay.
So that is how I use MNAV long term. Before that, I used to differentiate MNAV using fully diluted shares versus diluted shares. That's another way I used to do it. When you model this out statistically and you do structured variable analysis, Bayesian analysis, so on and so forth, different kinds of statistical modeling, pure MNAV, that is just a derivative of the Bitcoin holdings and price and market cap, gives you a more accurate gauge of what market sentiment is doing. Because when I model it back and I do something called change point analysis, and I'm getting very, very technical here, so I apologize. But when I do something called change point analysis, whenever the price has dropped off a cliff, in my script, in my algo, the diagnostics pops up change point dates. And if I can look back at the price action, price has always dived after change points. So what that tells me is, and I try this with fully diluted shares, diluted shares, undiluted shares, market cap, and Bitcoin price derived MNAV. That's the long-term modeling that I have. That is more accurate of a gauge of what price does in terms of, or what price has done rather, in terms of market response. EV MNAV is actually the worst if I'm trying to look at what the market is doing because it's contaminated by capital structure. The preferreds are included in that. So it contaminates the signal, quote unquote, if you're trying to look at a gauge for what MNAV is doing and using MNAV as a gauge. And I'm saying all that to say this. The reason why I don't use MNAV is because I've been modeling it out long enough to know that you cannot predict what the market is going to do based on where MNAV is. You can only see what the market has done. And then looking at what the market has done is giving me two data points. One, pure MNAV, whenever it's fallen off a cliff and whenever it started to trend down, there's been clear signals in the data that it was going to happen when you look back on the data. Two, strategy and other treasury companies, when you model them out in terms of a holistic structure, so in case of strategy, that's looking at MNAV, that's looking at the options market, that's looking at realized volatility, that's looking at implied volatility, that's looking at gamma exposure, open interest, so on and so forth. It has traded in very, very specific regimes that I like to call them. In those regimes, there are also two additional realizations. One, when Bitcoin is going up, the regimes move kind of in tandem. When Bitcoin is going down, they do this. And what that means is when Bitcoin is trending down, strategy price action decouples from Bitcoin. So you have a reality where, how do I trade this equity if I'm using MNAV? Well, when MNAV is low, it decouples from Bitcoin. When MNAV is high, it's more closely correlated with Bitcoin. So do I change my strategy based on what Bitcoin is doing? Okay, I tried that. Then there's been other times where it decouples even further. Bitcoin goes up and the strategy goes down. So again, that's just using MNAV as my main gauge, right? That's why I say I don't use MNAV. It's not because I have an issue with it. It's because I've modeled it out, and it's not something you can realistically trade on for long periods. If MNAV's at like 3, and you're saying, oh, the market's kind of overheated, you're making a subjective assessment, but it's likely that MNAV can probably drop down at that point to 2.5. So if you want to use that for short-term trading, sure. But the only trading that I do is with options. And that I don't look at MNAV. I look at realized volatility. I look at implied volatility. I look at all those other factors. And that was a very long answer. I'm sorry.
Yeah. Do you think what Saylor said, where he said, I'd love to see MNAV go from 3, 4, 5, 6. Do you think that that's just bull talk and has no basis in reality given the current strategy? Or do you think that there is some combination of macro and operational efficiency and overall market awareness that Bitcoin and strategy are viable, and the future, the future base layer of money and the securitized layer of that base future of money? Like, is there a combination of events that you think could actually lead to MNAVs of 4, 5, or 6?
Well, so Saylor did say that, but he also, remember what I said earlier, he said that market sentiment, belief, and so on and so forth was going to drive MNAV. So
yeah, which was a huge like nod to you, by the way, because you've been on that the longest.
Yeah, I have, with the most attacks for it as well.
You've earned it.
So here's the reason why I think that it's important. Yes, I think that MNAV can be higher because MNAV is sentiment. It is market sentiment. When Bitcoin is eventually at 150, 200, 250, so on and so forth, the overall sentiment is going to be obviously very high. And I think strategy can see MNAVs of 3 again at some point, maybe even 4. 5 or 6, that's a little bit much. That would have to require a blowout in Bitcoin, right? A real blow off top. I also think that in terms of Bitcoin price action, we were at 126. We dropped down to I think it was just under 70 for a bit. Then we trended back up.
60, actually.
Oh, 60. Yeah, there you go. And then we trended back up. The future of Bitcoin is still being determined in this next 1 year period. And what I mean by that is, if we see like a drop down to 40, then the cycle bros are going to come back and say, see, we're in a cycle again. But I'm bringing it up to say that right now Bitcoin is in a spot where I think it's becoming truly steady state in a sense of, we have the ETFs, we have the financialization of Bitcoin through strategy, we have the little bit of progress, I guess you can say, with SVR, in the sense that the U.S. government's not going to sell any Bitcoin, right? The narratives are piling up. If things stay where they are right now, and then we go to 90, 100, and we start trending back up in 27 into 28, and so on and so forth into the next halving, strategy is going to disproportionately benefit from that, because the Bitcoin treasury space is becoming the Bitcoin space. And in my view, the Bitcoin miners that were attracting a lot of attention away from strategy, they're moving more purely into the AI space. So they're going to attract a different investor cohort. Altcoins, sorry, altcoin bros, they're dead. Ethereum is still around, Solana is still around, but I think the meme coin cycle that we had, that kind of killed the last altcoin potential, because there was one thing to have thousands of altcoins, but now we have millions. There's too much dilution in the space for anything to really do anything, right?
And I think the treasury companies actually stole a lot of the thunder. Obviously you can't compare those two, but what I've seen, like before strategy and all the other treasury companies got popular, altcoins were always the way to get more Bitcoin. That whole narrative of invest in something to get basically more Bitcoin, or like you outperform Bitcoin, is just purely on the treasury company side now. I feel like I feel like treasury companies might have slowly killed the meme coins.
Yeah, so that's something I posted about. I think Adam Bacchus posted about it. Other people posted about it. It was treasury season. We didn't have alt season. We had treasury season. And I think that to your point, they stole the thunder from the altcoins. They really did. Now, all that kind of plays with what I'm saying here, in the sense of, when strategy is already the primary vehicle for leveraged Bitcoin exposure, when it becomes the only vehicle in the space for Bitcoin exposure, with a few smaller treasury companies getting interests, like, Metaplanet, Strive, so on and so forth, the growth is going to be concentrated even further into Bitcoin, with the miners and all these other alternative plays being moved into AI, HPC, data center plays. The concentration is going to become even greater the next cycle. So once we get through this price action here, I think that seeing MNAVs of 3 for a strategy isn't impossible. But I also think, if I'm being fair, I don't think we're going to see Metaplanet blow out to 15x MNAV either. That's not going to happen again. It's going to see a multiple, but I don't think it's going to see those kinds of disproportionate multiples. Because what we saw this last year is that strategy was a beta Bitcoin play. The treasury companies were a beta strategy play, and people were going into them because smaller market cap means they can move up faster, and it can have disproportionate returns. And I think, and that's what we saw with the treasury companies. So now that that's died down and things are becoming more steady state, Metaplanet is doing the preferreds. You have strategy with preferreds. You have Stripe with preferreds. Maybe Smarter Web will get preferreds, or maybe we'll see more mergers and acquisitions in the treasury space with some of the other companies as well. It's going to become more consolidated, more concentrated, and strategy is going to get benefit from that. I think MNAVs will go higher. And again, I'm sorry, I gave a very long answer.
What would be Saylor's incentive to let MNAV run past 3? Because isn't MNAV only valuable to strategy insofar as their ability to hit the common equity ATM to capture, Bitcoin per share at the premium? So like, why would he ever just let it run as opposed to capturing it for more Bitcoin on the balance sheet?
Well, he's not letting it run. Remember, he's not controlling MNAV.
We'll see this where where there's nuance to your statement, where it's like they don't have control over MNAV. It's true that they don't have control over it, but they do have control to some degree on how much they let it run above the premium, right? Because they can be hitting the ATM to kind of pull back the runaway MNAVs of 3, 4, 5.
Not necessarily, no. Here's why. They have I've actually watched the price action, and I've actually modeled the price action as they're issuing shares. They've issued in 2024, they issued at 2, it went to 2.5. They issued at 2.5, it went to 3. They issued at 3.25, it went to 3.5. They issued at 3.5, went to 4. The ATM issuance is not what's capping MNAV, it's market sentiment. And the ATM is issued as a function of market sentiment. It is not a driver or a cap to market sentiment. So to give your point some fairness, based on what I've been able to model out, in high sentiment environments like we've seen in the past, they can issue up to 15% consistently, and price won't move. They will not drag the price down. If they go to 2025, then the coefficient drag becomes much, much higher. The standard market assumption is 0.4 of a coefficient if you're trying to do a statistical regression model on just share issuance. So accounting for nothing else, not the options market, not anything. The usual coefficient is 0.4. If they start going to like 15, 20, 25%, you have to bump that coefficient up to 0.8 or 1 or 2. And then the drag starts to increase. But even in that event, the drag on price, and when I say drag, I'm talking about attribution. So again, with this modeling, you're only assuming share issuance. You're not controlling for anything else. So it's a very, very noisy aggregation. But it goes from 0.000016 to 0.00028. So even if they're issuing shares into a high sentiment environment, they would have to go absolutely crazy issuing shares before that overpowers what's going on in the market. And that would have to overpower short interest. That would have to overpower open interest. That would have to, short volume. That would have to overpower open interest. That would have to overpower what's going on in the options market. So Saylor is not necessarily letting it run. Now, coming to what you're asking about structurally, if they have a 1.5, 2, 2.5, whatever MNAV, they're going to be issuing shares. So it's not so much about would Saylor let it run. It's more so about why would Saylor leave that much money on the table.
Right.
So to your point, I don't think that they will. And that's why I think that the messaging that they're using is very market adaptive. But as we saw with the MNAV guidance they gave last year, all people saw was 2.5. They didn't read anything else. All they saw was 2.5, and them issuing shares below 2.5. That's all they saw. They didn't see the fact that there was a very detailed SEC statement that said at management discretion. So I don't think they're going to put themselves in that position anymore. If they have the premium, they're going to use it.
And so, sorry, last question, guys. I know I'm monopolizing a bit, but so your modeling shows that the VWAP kind of ATM issuance of the common really does, as Saylor says, not move price, that they only ever, tap the ATM when they are not directly moving price either up or down?
Yeah, there's three different analyses that you can do, and there's 3 different analyses that I've done. Going back to 2020, so August of 2020, all the way till November 28th of 2025, I modeled out the ATM issuance the following way. I took actual SEC issuance, so based on the actual SEC filings going back to 2023, then I extended it all the way to 2020, assuming the same level of issuance. So I essentially serialized it over that time frame. Going back to 2020, it could be attributed to price 0.0003%. So that's statistically indiscriminate from 0. And when I say attribution, what I'm saying is I'm doing a statistical model that's accounting for all kinds of market dynamics. And when you model those out statistically, this is the attributable factor towards potential share issuance and how it can affect price. But that is bidirectional. I cannot say that as positively correlated. I cannot say that as negatively correlated. That's simply saying that in potential price action, 0.0003. Going back to 2020. When I account for the options market, going back to August of 2024 to the last time I ran it in November 2025, it's 0.1. So 0.1% is what I can attribute to share issuance in terms of the price action. But again, that's just me saying potential impact. That's not me saying this is what it was. So with that said, short interest was several orders of magnitude higher. Options market, sector rotation, ETFs, implied volatility, VIX, the Bitcoin direction, all of those were several hundred times more attributable to price action. So when Saylor is saying that it's not, when they issue the ATM, it's not moving price, what people don't understand is that the actual issuers of their shares in the market, the institutional issuers that are helping them sell shares to the market, they're giving them variance attribution analysis. So they're telling them, we issued this amount of shares, and in all likelihood, they're doing what's called a STRM, a square root impact model, that's using that same 0.4 coefficient, coming to the other level of analysis that I've done, to tell them, this is the actual dollar amount that we can say, in theory, issuing these shares into the market took away from the market. And even at the highest issuance, using that very, very basic model that doesn't account for anything else, I think the highest number I got to was $10 million, just over. But that was when the volume was its highest. That is when the issuance was its highest as well. So you can model this down to the actual basis point shift. You can model it down to the actual dollar amount shift as to what share price issuance is doing. But if you have $1 billion in share and volume, and the only thing you can attribute to it is 10 million, is that moving price? Again, it's statistically indiscriminate from 0. So no, the ATM has not been driving price up or down. It's essentially net neutral at worst. At best, it's noise. And again, sorry for a long answer.
I learned so much already, man. Thank you, you three for coming on this, because I think it's really valuable for me personally, and I hope some of the people also learn something from that. I just saw that we are almost 1 hour over time.
I didn't know that. Sorry.
No worries. Especially, I think for Peter, it's already late in the day.
It's always a pleasure listening to Adrian, and one of the big takeaways is that I got to start studying the option market a lot more when it comes to MSCR.
Yes, the option market is super interesting. But yeah, I will close it down with thank you so much, guys, for coming on this live, for everyone that has come here, also listening live. We have really cool. We had a lot of people actually listening to this live, which was cool to see. I didn't know if, because we haven't announced it, we haven't promoted it. I was like, let's just go live, see if people find it and see it. Apparently they do. So thank you so much, Chase. Thank you so much, Peter. Thank you so much, Adrian, for coming on this new panel. And we will be doing this as much as we can. We will aim for how do you say, semi-monthly, so twice a month, not daily, like Sada. We have the strategy, the stretch ribbon in the issuance of this treasury panel. So thank you so much, guys, for coming on, and we'll be back on Tuesday with the other panel, and Thursday in 2 weeks with this exact panel.
Yeah.
Thank you.
Thanks, guys.